All right, let's jump right into it. Today, we're tearing down Target's latest third quarter earnings call. We're going to break down the key numbers, unpack what management had to say, and really figure out what this all means for the stock going forward.
And wow, the market did not waste any time making its opinion known. The stock dropped almost 3%. And get this, on more than double the average trading volume. Now, that's not just a little dip, folks. That's a big flashing signal. So the question is, what exactly did Wall Street see that sent them running for the exits? Let's dig in.
So here's how we're going to break this down. We'll start with the earnings snapshot, then look at what's behind those disappointing sales numbers. We'll check out their big AI turnaround plan, see how the market reacted, and then wrap up with our own outlook and a trade idea. Okay, first up, the Q3 earnings snapshot. Let's get into the numbers that really set the stage for this quarter. So here's the story in a nutshell. On the surface, it looks kind of okay, right? Adjusted earnings per share came in at $1.78, beating estimates by 6 cents. But, and this is a big but, this wasn't because they sold more stuff. Revenue actually missed, just barely. And here's the real kicker. Comparable sales, down 2.7%. That's the third quarter in a row of negative comps. This is what we call a low-quality beat, you know? It's all about cutting costs, not about growing the business. All right, so let's peel back the onion on that negative 2.7% number. Because when you do, you see a business that is really, really divided. And here is that split, clear as day. Their digital business, it's actually doing pretty well. It's up 2.4%, mostly because of a huge jump in same-day services like pickup and delivery. But all that good news is just getting wiped out by the heart of their business, the actual physical stores, which saw sales drop by a painful 3.8%. You see the same divide in what people are actually putting in their carts. Shoppers are still coming in for the essentials, food and beverages. They're also buying what management is kind of cutely calling Fun 101, think toys and games. But when it comes to the high-margin stuff, like apparel and home goods, yeah, they are slamming on the brakes, hard. And really, when you get right down to it, it all comes back to this one number. Store traffic was down 2.2%. It's that simple. Fewer people are walking through the doors, and that is the root cause of the problem in their biggest, most important channel. Okay, so we've established the problem is pretty clear. But what's the plan? Well, management seems to think the answer is technology. They are going all in, betting big on AI to get this ship turned around. The new guy in charge, incoming CEO Michael Fidelki, laid out a 3-part plan. Basically, 1, get the right stuff on the shelves. 2, make shopping at Target a better experience no matter how you do it. And 3, use tech to make everything faster and more efficient. And to their credit, they're not trying to sugarcoat it. Fidelko was super direct on the earnings call. He basically said, we know these results aren't good enough, and we're working like crazy to get back to growth. It definitely signals a sense of urgency. And the plan itself is, well, it's very techy. They're using AI tools with names like Target Trend Brain to try and spot trends faster. They're partnering with ChatGPT to let you kind of talk to an AI to place an order for pickup. And this is a big one. They're cranking up their capital spending by another $1 billion in 2026. Make no mistake, the strategy here is to spend their way back to growth. So management has laid out this big tech-heavy plan. The big question is, did Wall Street buy it? Well, let's just say the reception was a little chilly. The first big red flag actually came from Target themselves. They cut their guidance for full-year earnings. Now, they kept the bottom of the range at $7, but they took a big slice off the top, bringing it down from $9 to just $8. Yeah, let that sink in for a second. They lopped a full $1 off the high end of their earnings forecast for the year. That is a huge reduction in optimism. It's basically them telling us they are not feeling very confident heading into the most important shopping season of the year. And you better believe the market noticed. The stock traded on more than twice its normal daily volume. Look, this wasn't just a quiet little sell-off. This was a high-conviction move. This was big money, the institutions changing their minds and repositioning their bets based on this new, much weaker outlook. The Wall Street analysts, the sell side, they quickly followed. I mean, look at this note from Bernstein. They're sticking with their underperform rating and they're slashing their price target down to $80. And their reasoning? It's the exact same stuff we've been talking about. Weak store traffic and tough competition. Plain and simple. The market just isn't buying this turnaround story, at least not yet. Okay, so that's the story of Q3 and Wall Street's reaction. So where do we go from here? This brings us to our final section, the next call, our take on what's coming down the pike for Target. So, what's the call? What should you be looking for in Q4 and into next year? Okay, here's our take. First, we just don't see a quick fix for this traffic problem. We're expecting comparable sales to stay negative right through the holiday season. Second, to even try and get people in the door, they're going to have to get super promotional, and that's going to squeeze their margins. And third, what does that mean for the stack? We think it's probably going to be range-bound for a while, basically dead money. It's not going anywhere until management can show us with hard numbers that all this spending is actually leading to real, sustainable growth.
So when you add it all up, the weak sales, the risk that their big investment plan doesn't work out, and just a really tough environment for consumers, our official rating on Target is underperform. And that brings us to the final piece of the puzzle, the trade. Given everything we've talked about, what's an actionable idea here?
The idea is pretty straightforward. Maintain a bearish stance heading into the holidays. And the rationale really boils down to three things. Number one, that drop in store traffic isn't a blip, it's a fundamental weakness. Number two, spending billions of dollars on a turnaround plan when consumers are pulling back, that's a huge execution risk. And number three, the competition from places like Walmart isn't going away. In fact, it's getting tougher, and that's going to force Target to cut prices and therefore margins to stay in the game.
And of course, as always, we have to say it, this is not financial advice.